So you've got a mortgage and you've got some extra cash flow coming in each month. If you want to get rid of that mortgage payment, the obvious thing to do is to make extra payments on your mortgage. But there's another strategy to consider that could actually pay off your mortgage even faster and give you more peace of mind in the meantime. That's what we're tackling in today's video. I'm Jordan Nitzel, founder of Trek Wealth Planning, and we help you make smarter money decisions. All right, so let's look at an example here of a $300,000 mortgage, 30-year fixed rate at 4%. The monthly payment on that mortgage is $1,432 per month. And then down here in this yellow box, I have us making an additional $500 per month payment on that mortgage. And then you can see in the green box, instead of 360 monthly payments, which is what if you just made the minimum monthly payments on a 30-year mortgage, be 360 total payments. With that $500 extra payment, we're gonna actually pay off that mortgage in 220 monthly payments. So we're gonna pay that mortgage off more than 10 years faster by making those extra payments.
All right, so in that example, if we pay an extra $500 per month on the mortgage, we're gonna pay off the mortgage in 220 payments, which is 140 payments less than if we just made the minimum payments on the mortgage. But another thing we could do with that extra $500 per month is we could invest it. And once our investment balance, minus the taxes that we're gonna owe on our investment gains, once that's greater than our outstanding mortgage balance, then we could sell our investments and pay off the mortgage. So let's look at an example of that.
So we're gonna look at the same mortgage example, $300,000, 30-year fixed rate at 4%. But instead of making $500 of extra monthly payments on the mortgage, we're gonna invest that extra $500 per month of cash flow. And we're gonna assume that we earn 8% on our investments. That's roughly the long-term average of US large cap stocks. So again, we're just gonna use that as an assumption. May not happen in the future, but that's what we're gonna use in this example. And then we're gonna also have to pay taxes on our investment gains. And so we're gonna assume a tax rate here of 15%. So now, after 194 months, our investment balance after paying taxes is gonna be more than our outstanding mortgage balance, which means then we could sell our investments and then use those proceeds to pay off the mortgage. So by investing the extra $500 per month and earning 8% per year on our investments, we were able to pay off the mortgage in only 194 payments compared to the 220 that were required by making the extra mortgage payments. The reason that this worked in the example is that our investment return of 8% minus taxes was more than our mortgage rate of 4%. The catch, if you want to call it that, is that 8% investment return is not guaranteed, far from it. You could earn more than 8% on your investments, you could earn less than 8%, you could even lose money on your investments. And so you want to factor that risk into your decision. If my investment return minus taxes had been less than my 4% mortgage rate, then I would have been better off making the extra mortgage payments. I think the invest or pay off your mortgage debate often gets pitched as you can only do one or the other. The point that I'm trying to make is at the end of the day, if you just don't want to have a mortgage payment, you might be able to do that faster by investing. I also want to touch on another big advantage of investing versus making extra mortgage payments. One thing people often say in defense of making extra mortgage payments is that being mortgage free creates this freedom and flexibility and peace of mind. If I lose my job or if I want to take some time off, then I don't have to worry about a mortgage payment. And there's definitely value in that once the mortgage is paid off. But in the meantime, making those extra payments may actually create the problem that you're trying to avoid. Let's say you're a few years into making those extra payments and you get laid off from your job. Well, your mortgage balance is a lot lower, but it's not paid off. So your mortgage payment hasn't changed, but now you don't have an income. If you had been investing those extra dollars instead, well, now you'd have a big pile of cash there that you could use to make your mortgage payments and pay for your other living expenses while you look for a new job. So I think this is another reason why investing the extra cash flow can be beneficial, even if the ultimate goal is to pay off the mortgage. I hope this video was helpful and gave you a new perspective on the invest versus pay off your mortgage debate. Obviously, I'm presenting one side here. There can definitely be cases where it makes sense to make extra mortgage payments. Everybody's situation is unique, and so if you're curious about your specific situation, I'd recommend talking to a financial professional. My firm, Trek Wealth Planning, helps families with decisions like this all the time. So if you want to check us out, you can go to trekwealth.com. Don't forget to hit the thumbs up button and subscribe for more content that's going to help you make smarter money decisions.